Please show a warm welcome to Erik Norland. We're talking all things macro for us with an Aussie smile.
Right, absolutely. So, yes, I think that I've titled the presentation "Financial and Practical Consequences of an Over-Leveraged Global Economy." And so, I think that one of the sort of defining features of the era in which we live is the level of debt that has been accumulated in almost all of the developed countries, including now more recently a number of emerging market countries. And I think that that has very, very long-term consequences for how markets are going to behave, not just in the next coming weeks or months, but going maybe half a decade or maybe even a decade or more going forward. Now, one thing that differentiates a presentation from CME Group versus, say, an investment bank or a broker-dealer is that we are not allowed to make any trade recommendations. So now that you've read the short version as well as the more detailed version of our disclaimer, I'm sure you will all agree that if you believe at any point in the presentation that you heard any trade recommendations, it's only because you misunderstood me because of my American accent. So, yes. And so, I think that one of the things that is very interesting in terms of Australia is the sort of dependence upon natural resource exports. And so 1/4 of Australia's natural resource exports, move it up a bit. Yeah, okay, good. Move the mic up a little bit here. There we go. I don't think it can go much higher than that. So hopefully, is that going to be okay?
Thank you.
All right, good. Yeah. So one of the things that I think is interesting about the Australian economy is the vast majority of the exports are natural resources, and fully 1/4 of them are iron ore, which is a product that's been trading at COMEX now for about, maybe 5 years or so. We're not maybe the dominant exchange on it, but one thing that's interesting about it is how closely it seems to move with the Australian dollar. As the price of iron ore moves, the Australian dollar often seems to move with it. It's not a lockstep 1-to-1 correlation. But I think that what's fascinating about iron ore as a commodity is that it's overwhelmingly used in China, which is a country that's undergoing, as we'll see in a moment, very, very rapid debt accumulation. So the Chinese use 2/3 of the world's iron ore. For most of the other industrial metals, they're using maybe 40 to 50%. But the reason why they use so much iron ore is that unlike countries like Australia, the United States, our peers in Western Europe or Japan, they don't have a lot of steel to get recycled. They're still kind of a growing, expanding economy, building a lot of new automobiles, building a lot of new buildings, etc., that require steel. They don't have much steel to recycle. And so they're the overwhelming consumer of iron ore. It's something that Australia is very dependent upon. And I think it's interesting to look at. The other thing about iron ore that I think is really fascinating is that the supply of it is burgeoned. Most supplies of industrial metals have roughly doubled over the last 2 decades. Iron ore supplies have more than tripled. And so I think that the sort of huge supply of iron ore is also putting really big downside pressure on that area of the economy here in Australia. But that's all I'm going to mention about iron ore. But I'd really like to focus on sort of the main theme of the presentation, which is debt. Now, when people talk about debt, at least in the United States or in most European countries, it's often in a very political context. How big is the government debt? Who's been spending too much money? Who's been allowing all these deficits to accumulate, etc. I want to sort of take a step back from the political aspect of debt and to look at it in a much broader, sort of much more holistic way and think about what the consequences are for the economy. And so the first thing to pay attention to is that most debt is not government debt. So here in this chart, you see the black part of the graph is the government debt. The dark blue is households, and the lighter blue is non-financial corporations. So basically everybody except banks. The reason why banks are excluded is if you include them, they're essentially double counting the debt. Because they're essentially borrowing money from their depositors or from central banks and lending it out. They're excluded from the banks for international settlements calculation. And it's also important to realize that most crises that begin as a result of excessive levels of private sector debt. Now, of course, there are exceptions like Greece, for example, which began as mainly a public sector debt crisis. That's mainly because the Greeks gave up sovereignty of their currency when they joined the euro, so they can't devalue their currencies like most other countries can. And so the problem of debt is really mainly a private sector problem in most countries. Now, here this graph shows essentially the same, except in the black part here it shows where the debt levels were as a percentage of GDP back in the year 2000. And then in the blue part it shows how it evolved by the first quarter of 2016. And so what you see is a very, very clear theme. Almost all around the world, countries have dramatically levered up the amount of debt that they have on their balance sheets, both in the public and in the private sector. And this, I think, has very, very profound consequences for interest rate markets most notably, and then secondly, through the interest rate markets for currencies, for real estate, for equities, and even for commodities. And so we'll kind of go and explore what we think those consequences are and how they're going to affect markets here in Australia, as well as markets around the world that you could potentially be trading.
That's interesting there that Australia's debt is a lot lower, government debt's a lot lower.
Yeah, that's one of the striking features of Australia. Is Australia has a rather small government debt. You know, it's just maybe a little bit above 50% of GDP, where Australia has an absolutely colossal household debt in particular. I think it's probably a product in large part of the real estate boom that's taken place here. So one of the arguments that we can make is that Australia looks, in some respects, not in every respect, but in some respects, a lot like the US did in 2007. But we'll go into that in more detail. I think the outcome is going to be different in important ways. So we'll take a look at what some of the similarities and differences are a bit later on. But you're right, Australia is very exceptional in the sense that it has very low government debt, but quite a colossal private sector debt. So, I think that, Japan in some ways is sort of an odd place to start, but it's still a very, very important country for Australia. China is the biggest export market for Australia. It takes 37% of your exports, but Japan is the second biggest one. It takes roughly half that amount, 18% of the exports. And so Japan began in the 1980s with below 200% debt to GDP. And as the 1980s went on, they had this great economic boom. I think most of the people in this room are too young to remember the 1980s, but in the United States there was a lot of paranoia about Japan. Like our sort of mid-level magazines, like Time and U.S. News and World Report and Newsweek used to have these cover stories about how the Japanese were going to take over the world. They had the world's biggest banks, they had their auto manufacturers, etc. They seemed almost headed toward world domination, and the United States seemed to really be stagnating. But then something interesting happened. So in 1990, when they got to around 275% of debt to GDP, their real estate market blew up. Real estate prices started crashing, their equity market crashed. The equity market still has not hit a new record high since December 31, 1989. And it's roughly trading at half those levels today as it was over a quarter century ago. And so Japan, though, in some ways was lucky and in some ways was unlucky. So they were lucky in the sense that their debt blew up at a time when the rest of the world economy was still growing quite strongly. So the US and Europe had nice expansions in the 1990s, and as those expansions sort of stalled after the year 2000, Japan could still export a great deal to China, which of course had a burgeoning economy, as well as many other emerging markets. But they were also unlucky in a sense too, and so Japan was unlucky in the sense that they were the first country, at least since the end of the Second World War, that had a really big financial crisis that was largely denominated in their own currency. Now, there were lots of countries that had financial crises. There were certainly emerging market crises in Latin America. There was the Asian crisis in the late 90s. But these were mainly countries that had borrowed in foreign currencies and then had to devalue their currency, but still owed the money in foreign currency. But Japan was mainly a domestically generated crisis. All of the money had been borrowed in yen, not in dollars or Deutschmarks or some other currency. And so Japan in some ways was a canary in the coal mine, and so they didn't really know how to respond when the crisis began. So they were very, very slow to lower interest rates. Interest rates in Japan did eventually come down, but they didn't actually get to zero until 1999, nearly a decade after the crisis had begun. During this time, Western economists were giving the Japanese all sorts of advice. They were telling them, well, you should just let your banks collapse. You shouldn't merge your good banks with your bad banks. All sorts of advice was being given to the Japanese that we would hypocritically neglect ourselves a decade later. But what's very interesting about Japan is really two things. I'm going to go back. So first of all, after the crisis began, there was no deleveraging. Japan has continued to lever up. They've continued to add more and more and more debt. And that's something that we're seeing to a lesser extent in the Euro area and in the US, which we'll look at in a moment. But the other thing that's very interesting about Japan is that as interest rates hit zero, they tried twice and failed twice to get off the zero interest rate bound. At the peak of the economic expansion in the 1990s, they actually got interest rates back up briefly. They had to put them back down during the 2001 recession. They tried raising them again in 2007 and 2008, near the peak of that expansion, and eventually had to put them back at zero. And so this is something that became familiar later on in other countries like Sweden, that also tried to get their rates up off of zero and wound up having to go back down. So Japan in some ways was a canary in a coal mine, but the US, as I mentioned, while we were giving the Japanese all sorts of advice back here in the 1990s, we began this huge levering up phase after the year 2000. It sort of was a second wave of levering up from what we had during the 1980s. And so here in the US, of course, we began our crisis when we got to a fairly similar level of debt to GDP, around 230%. Since then, the debt to GDP has actually increased a little bit down to 252%. And much like Japan, of course, we've had to put our interest rates down at zero, or very close to zero. And so this shows our interest rates back to the 1970s. You can see most of the time, the interest rates here in blue have been, oops, pardon me, I didn't realize I could move it just by tapping that lightly on the screen, but I guess I can. We're in the black shows the level of interest rates, or level of inflation. So normally, we would have the interest rates above the rate of inflation. But since 2008, that's not been the case. And it's been very, very difficult for the Federal Reserve to raise interest rates. So this is the one interest rate increase that they got off last December, which was like the biggest news ever. They raised interest rates, the media spilled countless amounts of ink writing about this story. Yet you see how minuscule that interest rate move was. Back then, the Federal Reserve in December last year with their dot plot, which essentially tries to forecast where their rates are going, had this sort of preposterous idea that they were going to be able to raise interest rates 4 times this year. And so here we are, almost October, and they've gotten so far 0 interest rate increases. And the Fed funds future is now pricing maybe a 60% chance that they get 1 increase off. And so the question is, well, why? Why are they stuck at 0? I mean, when you look at how the labor market is behaving, I like to look at the labor market in a slightly different way, I think, than most economists. Most economists look at like NFP or whatever. I think NFP is a fine number, but I think it's better if you put it in like a percentage change year on year, which is what we've done here with the number of workers. This is the percentage growth. But I think it's also better if you sort of take the labor numbers and you chain multiply them. You take the percentage change in the number of workers multiplied by the average gain in salary per hour multiplied by the year-on-year change in the number of hours worked per person. So that brings you to this thing, the black line, which is total labor income. So total labor income, it chops around a bit from month to month, but in general it's been very steady. It's been growing at 4% per year, which is pretty decent growth. And it's been doing that now for 6 years, which means that the total amount of income flowing to the American labor force is up by almost 30% since 2010. Why are we still stuck at 0? And so the answer, in part is, well, we're still stuck at 0, and the markets had to deprice all of these rate increases for the very simple reason that with 252% debt to GDP, you can't increase interest rates very quickly without blowing up your economy and recreating the 1930s. The thing is, if you increase interest rates from 12 basis points to 37, okay, it doesn't really matter very much. Or maybe if we go this December from 37 to 62, that doesn't matter a lot. But if you actually get 4 rate increases per year, like the Federal Reserve said they wanted to last December, very quickly, a couple of things are going to start happening. For one thing, the federal government, which has a 100% debt to GDP ratio, has to refinance its debt. So some of that's of course all over the yield curve. So some of it though, like the T-bills, are very short term. So that's a substantial portion of the federal government's funding is T-bills that it could date anywhere from a couple of weeks up to a year in maturity. And so as interest rates go higher, that automatically and mechanically adds to the federal government's budget deficit. So if the Federal Reserve raises rates too quickly, the deficit expands very quickly at the federal level. But then you also have all the private sector corporations that finance themselves through commercial paper markets or through other markets, borrowing from banks, etc. Their funding costs would begin to increase as well. Now, there are many profitable companies that can easily afford to pay a little bit more in financing costs, but there's always a sort of marginal companies, particularly those in the energy sector, now that energy prices have collapsed, who could find themselves in real financial difficulty if interest rates were to start going up. You could start seeing sort of a downward spiral in economic activity. So I think in a sense we're sort of stuck at low interest rates. That doesn't mean that the Federal Reserve can't move in December. Again, doing a quarter basis point move in December probably won't change the interest rate picture too much for all of these indebted entities, whether they're governments, households, or corporations, but it limits the scope. And so right now you have 4.9% unemployment. The last time we had unemployment at that level was back in 2006. Well, back in 2006, Fed funds was 5.25%. It was nearly 500 basis points higher than it is now. And so the reason why we can't go back there is because of the debt burden. So we see something very, and this has, I think, a big impact on commodity markets. I think that the Fed funds future is very, very strongly correlated to gold, which of course is another fairly important export from Australia, since Australia has one of the world's biggest gold productions, right up there with Russia, China, South Africa, the US, and a few other countries. It's definitely a top 5 producer. Gold prices benefit enormously from the depricing of Fed rate hikes. So since interest rates have to essentially remain low for a long period of time, that takes the price of gold and elevates it to a much, much higher level than it would ordinarily trade at. Gold is essentially a de facto currency. It's used mainly in jewelry, it has very, very few industrial applications, and gold's big threat is high interest rates. Because gold doesn't pay any interest rates, as interest rates go higher in other countries, that tends to lower the price of gold, and vice versa. So the fact that the Federal Reserve being stuck not exactly at zero, but close to zero, has been quite good news for gold. We see a very similar pattern in the Euro area. They began their crisis when debt got to 240% of GDP, but their central bank responded, I think, quite differently than the US Federal Reserve. So first of all, they cut rates to 1% and not to zero, and then in 2011 they raised rates 2 times. They thought, low interest rates are harming the economy, so if we raise them back up, it will inspire confidence, and savers will earn more money, which is one of these arguments that you hear a lot, but it didn't work. They raised interest rates twice, the economy started falling off the cliff again. You nearly had Greece, Italy, Spain, Portugal, and Ireland default on their debt, in a currency that they have no control over, since they essentially sacrificed a large portion of their sovereignty when they joined the euro. And so eventually the ECB sort of righted course, if you will, and they put their interest rates at the lending rate here. The refinancing rate is the lending rate for the ECB down to zero. So we started seeing an economic recovery, but a very, very belated one. So Europe's economic recovery is much younger than the US. It's a much sort of really behind the curve. But the other thing that the ECB has done more recently is to put the deposit rate negative. And I think putting the deposit rate negative has been a real disaster for them. I think that central banks are typically loath to admit mistakes. They are typically populated by people who are very well educated, probably very proud of their history in school or whatever. And so they get in there and they make some policy mistake, and they're really embarrassed to admit it. Like the Federal Reserve admitted to having caused the Great Depression of the 1930s in the year 2005. So the ECB has now put their deposit rates negative. And so with a negative deposit rate, it's, I think, actually having the perverse impact of tightening monetary policy. There are actually people in Europe who are thinking, well, if I'm going to lose money by saving, then I should actually save more to make sure I can meet my objective later on. So I think one of the reasons why the euro has not sold off more is because of negative interest rates. And likewise, Japan instituted negative interest rates, at least certain rates negative in February. We've seen the yen soaring, which I think is a very, very unexpected outcome and a very corrosive outcome to Japan, which had actually been in a fairly nice economic recovery cycle. There's a lot of criticism of Abenomics, but I think Abenomics in general was actually achieving results. But the fact of a much, much stronger yen, it might be in part the result of negative interest rates, I think is very potentially damaging to their recovery and could potentially derail it. Let's switch gears for one moment and sort of talk about how does this low interest rate environment impact the equity market. So the equity market, I think, is in a very interesting state right now. Here I have the cyclically adjusted earnings yield for the S&P 500. And the cyclically adjusted earnings yield is something that was come up with by Robert Shiller, who won the Nobel Prize a few years ago in economics. And essentially it's a very simple calculation. Instead of just comparing the price to current earnings, they take a 10-year moving average of earnings to sort of smooth it out over the course of the business cycle. And so interest rates here, which are represented by the 30-year bond yield in blue, have a pretty strong correlation over time with equity valuation levels. So you can see back here in the 70s, when interest rates are very, very high, earnings yields, which is essentially the inverse of the price to earnings ratio, were very, very high as well. You see the equity traded at very, very low earnings multiples back in the 70s. And then as interest rates fell during the next few decades, equity prices increased very, very dramatically. And of course, they got way ahead of themselves during the 1990s. They had sort of an equity bubble. Then it kind of reversed. But now we're in a state where equities actually have fairly average PE ratios or earnings yields compared to where they've been for the last 20 years. So in one way, you could look at the stock market and say, well, it's trading around 25 times its long-term earnings. That's kind of expensive, and that's true. It is somewhat expensive. It's somewhat expensive by its historical norms. On the other hand, you can look at it and say, okay, well, stocks may be expensive, but what's the alternative? I mean, are you going to really put your money in a government bond that yields 2% for 30 years? And you have to remember, the U.S. is now a high-yielding market. Not as high as Australia, of course, but it's still nevertheless a high-yielding market. You could pay 50 basis points per year in Japan. The Japanese government essentially pays 50 basis points per year for their 30-year government bond. Very similar in Germany. Government bonds on shorter maturities, like 10 years or 5 years in Japan, Germany, France, Switzerland, Denmark, and the Netherlands, are actually paying negative yields. You actually essentially have to pay the government their money in order to store your capital. And so the question is, given that situation, where else are you going to put your funds? Equities may actually be a safer, a better bet in the long term than putting money in government bonds where you have a guaranteed loss, either in nominal terms in the places that have negative interest rates, or perhaps a guaranteed loss in places like the United States where interest rates are still positive but below the rate of inflation. So you have sort of a guaranteed real loss, or a likely, in any case, real loss of capital as those bonds come to maturity. Now the U.S. equity market, focusing a little shorter term, is I think in a sort of a precarious state. And so part of what's happening in the U.S. is that corporate earnings have peaked as a percentage of GDP. Our corporate earnings in the U.S., just like in other countries, cycle as a percentage of GDP. So it seems to be about 10% of GDP corporate earnings tends to be about the ceiling, and the floor is maybe more around like 4, 5, 6%. So right now, we've come up to a peak in corporate earnings. Now they're beginning to decline. The Wall Street Journal had an article yesterday about how we're now in the 6th straight quarter of declining corporate earnings in the U.S. So you would think that would be pretty bad news for stocks, right? Stocks, in theory anyway, are supposed to be like a discounting mechanism for future corporate earnings. But when you actually look at what's happened, so earnings peaked here in 1997. It's sort of a long way, but not all the way into that bull market. But stocks didn't peak for another 3 years. They kept going higher. Likewise, earnings peaked again in 2006, but the stock market didn't peak until about a year later or so. And likewise, corporate earnings have peaked again really in 2014, but the stock market in the U.S. is still breaking up to new record highs. So yes, corporate earnings are past their peak. We're seeing a tightening of the labor market. We're seeing very slow productivity growth. And as wages and the number of workers increase and productivity growth stagnates, that necessarily depresses corporate profit margins. But that doesn't necessarily mean that the equity market is going to correct soon. The equity market may still have 1, 2, 3 years of upside left, but there's a little more to the story than that. Because the equity market isn't just a story of price, it's also a story of volatility. So here we have the same line here for the earnings, but as now we're comparing it to the VIX index, which I'm sure you all know is the measure of S&P options. And so here what we saw is that as corporate earnings peaked, or as corporate earnings were rising during the 1990s, the VIX traded at pretty low levels. But after it peaked and began to decline, we moved into a structurally higher level of volatility. So the VIX really seems to have sort of two states of operation. It has one of sort of low volatility environment, like we had between 93 and early 97, again between maybe mid-03 and mid-2007, and what we've had essentially since 2011, 2012, where the VIX is typically trading at 13%, maybe 20%, maybe on an exciting day a spike up towards 30%, in general sort of averaging around 16, 17%. But then it can go through these sort of phase changes, if you will, where it can go up to much, much higher levels. And so those much higher levels that we saw from 97 to 03, we saw, of course, in this massive vol spike with the 2008 crisis, they tend to happen during and after periods of declining corporate earnings. So I think one scenario that's likely for stocks is, yes, they may continue their way up, but the way up is not going to be anywhere near as smooth as the rally that occurred from March of 09 until the end of 2014. It may be, instead, a much, much more jagged rally that's much more prone to really, really violent corrections. And of course, that also has a feedback loop into fixed income, because as the equity market corrects, we could get enormous flights to quality. And as those flights to quality happen, it's conceivable that the US interest rate curve, which is still trading at positive levels, could be pushed down to levels that much more closely resemble what we see in Germany and in Japan. And then eventually, if earnings really start tanking in a big way, eventually equity markets will peak and we will in fact have a bear market. I think that bear market is more likely to happen if the Federal Reserve raises interest rates too much and inverts the yield curve. But imagine they go one more time this year and get to say 62.5 basis points for Fed funds. And then the equity market has a big correction in say a year's time. And maybe by then they're up to 87 or 100 basis points in Fed funds. And then suddenly you have 30-year bond yields trading at 70 basis points or 50 basis points like they are in Germany after an equity market correction. Well, then you'll have your yield curve inversion, which is often a sort of precursor to a recession. So I think that the US is in some ways in a precarious situation, which is why I think the Fed has to be so careful about moving interest rate policy. So I'm going to move on a little bit now and talk about Australia's main export market, which of course in some ways is the world's most important economy, China, which has been really the main growth driver of the global economy for the past 15 years. So China, going into our financial crisis in the US and Europe, had fairly low debt to GDP. Their debt to GDP was around 150%. At that point, they had a choice. They could either say, well, look, we saw the trouble that Japan got into in 1990, that the Europeans and the Americans have gotten into more recently. And we could decide not to go down their path and take on more debt. Or they could say, it looks like the Japanese, the Europeans, and the Americans really enjoyed their financial crisis. Maybe we should generate one of our own. And so they seem to have taken option B, the Chinese solution, if you will, to our economic crisis in the West was to lever up. So in 2009, China's economy had a big dip in growth, and the Chinese government essentially told the non-financial corporate sector, well, we need a great deal of additional investment. So that investment happened, and it was financed largely by a massive, massive increase in debt. So they've now gone up to 257% of debt to GDP, which is very similar to where we're at in the US and in Europe. I think that the problem here is that when a country's at a low level of debt and somebody borrows, whether it's a government, a household, or a corporation, that borrowing becomes income for somebody else, right? It becomes either investment spending or it becomes consumption, and it adds to GDP. But as debt levels increase, that relationship begins to change. At very high levels of debt, additional borrowing, mainly growth, necessarily slows. But as it slows, it also impairs the ability to service the existing debt, which can sort of generate a crisis and sort of a cyclical feedback loop. And I don't mean to pick on China. This is a Pacific Rim wide phenomenon. So you have little Singapore here, also joining the 250% debt to GDP club. Congratulations. South Korea, not quite there, but well on its way. Australia, congratulations, 242% debt to GDP. A lot of people are here in Australia are probably wondering, so why are interest rates at 1.5% for the RBA, right? You had a similar rate of unemployment, I can't remember, a decade ago or so, and at that time, interest rates here in Australia were, I can't remember, 5-6%, something like that. So a large part of the reason is because of the increase in debt. The RBA, somewhere deep inside the bank, they might not want to admit it publicly, but much like the Federal Reserve and the ECB, they know they can't keep interest rates very high and still have people finance this debt burden. So here in Australia, as I mentioned, it's mainly a household debt burden that I think is very closely linked to the massive increase that you've seen in real estate prices here over the past decade or so. The government debt here is rather minuscule, as we noted. But I think that the risk in Australia, though, is that if real estate prices begin to lurch over and begin to correct, the collateral that's backing all of these loans will diminish in value. And that was essentially the problem that set off our financial crisis in the US. But as I alluded to earlier, there's one important difference between Australia today and the US back in 2007. So in our previous tightening cycle in the US, between mid-04 and mid-06, the Federal Reserve raised rates at every single meeting, so 8 increases per year. They took the rate from 1% to 5.25, and 5.25 was more than the market could bear, and about a year after that, the real estate market blew up. Well, here in Australia, the RBA is not doing anything that remotely resembles that. In fact, they're moving in the exact opposite direction. They've been lowering interest rates now to 1.5%. And that should enable the private sector here to continue to finance its debt burden, I think, for a long while longer. Now, maybe the more likely scenario in Australia is for real estate prices just to stagnate, maybe for a long time, maybe even for decades, and for bank profitability to diminish as interest rates perhaps move a bit lower. But I do think that the future of Australia looks a lot like Europe and the United States and Japan in the sense that it's likely to be a low-rate environment. But the RBA, my guess would be, is they're probably trying to engineer a solution to this that does not involve an acute financial crisis and a collapse of the banking system like we had in the United States or in Europe. That would obviously not be politically desirable for any party that is currently in power. And lastly, Canada, very much in the same situation as Australia. And Canada also avoided an acute banking crisis in part because they lowered their interest rates down to a very low level. They just kept them there. And they're continuing to keep them there, even though their economy outside of Alberta's energy-producing sector is actually doing pretty okay. They've had a slowdown, but it's not too bad. And so getting back to China for a moment, from a global perspective, China is just enormously important. They have the world's third largest economy. The European Union and the US have bigger economies, but the thing is that China's economy was the growth driver. I mean, these two economies here are really happy if they can get, like 1.5%, 2% economic growth. So essentially, China's somewhat smaller economy, if it grows 6%, actually adds more to world GDP than the US or Europe does, even if they grow at half that rate. And then what makes China so hard to replace is that the other BRIC countries like Brazil, India, and Russia are each about 1/5 the size of China's economy. So if China loses 1% of GDP growth, it would mean that India would have to grow 5% faster in order to make up that contribution to world GDP. And of course, we know Brazil and Russia are a mess. because of a variety of reasons, including lower commodity prices. So really, the entire world economy is now really has its hopes pinned on India, which is growing at 7% per year. But the truth is, India is just too small to make an enormous difference in terms of resource consumption, et cetera, to the global economy. So China's real growth has slowed down a great deal, as is their nominal GDP growth. Now, when people look at GDP growth, they usually only look at the real part. I actually think nominal GDP is very, very interesting as well, because nominal GDP to me is great from a credit perspective. Because nominal GDP, of course, takes the real GDP, but also doesn't subtract out inflation. So what it represents is the growth rate in the cash flows that are available to service debt. And so we've seen there's just been this tremendous slowdown in the amount of cash flow that China, cash flow growth, I should say, that China is generating. So their 255% debt to GDP now is to be dealt with by a cash flow that's growing at 6% per year rather than one that's growing at 15% per year. And I think that increases the odds that at some point China is going to experience a fairly acute financial crisis. Now they too are attempting to avoid that in much the same way that the RBA is, and much like the RBA, also not admitting publicly why they're doing it. But they lowered interest rates a great deal over the course of 2014 and 15 to much, much lower levels. They're also lowering their reserve requirement ratio a bit as well. So they're essentially trying to make this debt burden affordable. Now the problem for China is this though. Their currency, even though they kind of moved slightly against the US dollar, is pretty closely linked to the US dollar. And so if they lower interest rates too much, it will create an incentive for capital to leave China, which could be really bad for their banking system because it would move from a higher rate environment in China, and if they cut rates to maybe more equivalent or lower interest rate environments. And so China essentially has to make this choice. Do they want to protect their banking system and their real estate market from blowing up? Or do they want to sacrifice their exports by keeping a currency that's probably a bit overvalued? And so their exports have been declining. There are a lot of people out there who wonder, is China sort of fudging its economic numbers? Are they sort of making up that they're really growing at 6.9%? I would argue that it's actually probably a pretty honest number. And the reason is this: when you go back to that really basic Keynesian model, when you calculate GDP, you add government spending plus consumption plus investment plus exports minus imports. And so what's really keeping the Chinese economy growing, if you want to call it that, is the collapse in imports. As they're being subtracted, this plunge in imports is actually adding back a lot to the Chinese GDP figure. And this plunge in imports is mainly an artifact of lower commodity prices. And China basically imports commodities, reuses those commodities, packages them to higher value-added goods, and then exports them to the rest of the world. But that won't last forever, the import contribution. So when you take that out, China's economy is probably really growing more like 5.5% per year. There's also some people who point out this electricity graph. I didn't put it in my presentation, but Chinese electricity usage is growing at 1% per year. I think that sort of exaggerates how slow their economy is growing. They are switching a little bit from manufacturing to services. Services don't use as much electricity as manufacturing does. But I think the Chinese economy in reality they've slowed down a great deal. It's slowed down a bit more than the official GDP figure would suggest. Some of the pressure has been taken off by a rebound in emerging market currencies. The rebound in the real, the ruble, as well as the Japanese yen, of course, has taken some of the pressure off of China to devalue its currency. But they have nevertheless burned through a fair amount of their reserves that come from $4 billion to a still very substantial 4 trillion to $3.2 trillion, which is still very substantial. But I think at some point, China is likely, between now and say the year 2020, which I know seems like a long time, but will go by quickly, is likely to have to devalue its currency in a more substantial way in order to help generate a bit of inflation, et cetera. And when that happens, I think it's likely to send shockwaves through the currency markets, equities and bonds. And I think that the sort of general pattern would be lower emerging market currencies, probably a lower Australian dollar, probably at least in the short term lower bond yields in a lot of countries, and maybe an equity market sell-off, depending, of course, on how well that move was eventually signaled. Now, India is a big contrast to China. As we mentioned, it's a fairly small economy, only $2 billion. It's not huge, but nevertheless growing at a very, very steady 7% pace. One thing that really differentiates India from most of the world is you have very, very low levels of debt. Debt levels are only 120% of GDP, so I don't think that that's likely to serve as a major impediment for further growth. Of course, they have to finance that debt at much higher interest rates than most other countries. It's being financed largely at 5, 6, 7, 8, 9% interest, depending on who's doing the borrowing and for what maturity. So it's still an expensive debt burden to finance, but the households essentially have no debt. You do have some corporate debt, the government debt's actually a little high on the high side for an emerging market, but I don't think in general that the debt level is going to stop India from growing. The main problem for the rest of the world is India's economy isn't quite big enough to pick up the slack from China. And it's also the only one of the 4 BRIC countries that's actually still growing in a substantial way. So we can also talk, I guess, briefly about energy. The energy markets are obviously still in the doldrums. I think one of the things that's very interesting is that after the U.S. lifted the oil export ban, Brent and WTI have now completely converged. So that difference in spread that occurred a lot during the Arab Spring, during the problems in Libya, is now reconverged. I think the collapse in oil prices, I think, is largely a story of increasing oil production. I think that the big news, of course, is in the U.S., where oil production went from maybe a little over 8 million to up to 14 million barrels per day of crude and crude equivalents. But it's not the only country that's increasing its production. Essentially, all of the majors, including Saudi Arabia, Russia, a combination of Iran and Iraq, China, Canada, and the United Arab Emirates have all increased their production a great deal. So I think that one of the things that's very interesting about the oil market now is that the forward curve is so unbelievably flat. We've seen this huge sell-off, and after past sell-offs like the one in 2008 and 2009, or the one back in '86, we saw much steeper curves. The market was anticipating oil prices would go much higher. That's not really the case now. And I think part of the reason is that inventories have exploded. So this is the inventories in the U.S. are just at unprecedented levels. I'm showing the U.S. inventories because it's the only country that really produces really frequent data to update them. The inventories around the rest of the world tend to be very, very opaque, sometimes to the level of being state or corporate secrets, and they're just not very well known. But the anecdotal evidence suggests that much of the rest of the world looks like the U.S. is just storing enormous amounts of oil. And so what that suggests to me is that despite the collapse in prices, that has not incentivized an increase in consumption that's adequate to absorb the increase that we're still seeing in supply in most countries outside of the U.S. Year-on-year inventories are still up around 11%. I know they took a little dip around Labor Day, so it might give a little temporary boost to the oil market. My guess, though, would be that the oil market's general tendency is towards lower prices. But there are reasons to be concerned that prices might go a bit higher. For one thing, U.S. production is on the downswing. It's down something like 11% or 12% from its highs. So the U.S. is sort of a swing producer. Countries like Saudi Arabia generally don't really want to cut their production. Of course, we know they're having an OPEC meeting today, so I might be surprised. I might be a bit embarrassed if the Saudis decide to slash their production. I think the reason why they're unlikely to do it is if they do cut their production, and it wouldn't be the first time. If you go back to this chart here, you can see that the Saudis here in the early 1980s sacrificed 60% of their production. And so that helped the world oil price to stay up during the early 1980s, essentially between 1980 and 1984. It kept the price at the time at $30 per barrel, which I know sounds low today, but was very, very high at the time. And the problem is, after the Saudis sacrificed all that production, well, what happened? All the other members of OPEC cheated, the Kuwaitis, the Iraqis, Iran, Venezuela. They were all cheating, all making, saying that they were going to adhere to quotas, but they weren't adhering to them. And so the Saudis are in no mood to repeat that experience, especially as they have such contentious relationships with so many other OPEC members, including Iran, with whom they currently have no diplomatic relations. If they cut back their production, they'd have to trust other countries to do the same. They have no reason to trust them, and they have no reason to want to help them since Iran's a major regional rival. And likewise, if they cut their production and raise the price of oil, it could also encourage the frackers in the United States to ramp up their production again. And I think even more frightening for the Saudis over the long run, it would encourage other countries to adopt the technology that allowed this massive spike in US production and begin deploying it elsewhere in the world, which would also not be in the Saudis' best interest. So I think it's unlikely that the Saudis will agree to any really serious reduction in output. They might agree to a cap, but even if they do that, it's sort of hard to enforce. So essentially they've succeeded in killing investment in the US oil and gas sector. It's down to levels it really hasn't been at, even in the last 2 decades. So in some ways the collapse in oil prices has been very successful though. Now oil does have upside risks though. And so I think the main upside risk comes from a sort of geopolitical framework, if you will. So the main problem in the oil markets is that there are only a couple dozen countries in the world that are net oil exporters. And so these countries here, these dozen or so countries, essentially represent about 1/7 of world GDP. So the other 150 or so countries that represent the other 6/7 of world GDP are essentially benefiting a small amount each from the collapse in oil prices. But the countries that are the main oil exporters are suffering really, really acute and in some cases very, very deep pain. And a lot of these countries are not particularly stable. So I would put those countries into sort of different categories. So here, on the x-axis, we essentially take these bars here and we measure what percentage of GDP that the collapse in oil prices wipe off from these other countries. And then here on the y-axis, we have the size of their foreign currency and sovereign wealth fund reserves as a percentage of GDP. So some countries are very well protected. If you're Kuwait, United Arab Emirates, Saudi Arabia, Qatar, well, you have enormous reserves, so it doesn't really matter all that much. But there are other countries though that don't benefit from those kinds of reserves and have nevertheless taken a huge hit to their GDP. And some of these countries I think have the potential to become very, very unstable. And a lot of them are countries we don't really think very much about. But let's mention 5 of them quickly. So in Angola, which has about a 2 million barrel per day production, it's roughly maybe 1/5 or 1/6 of what Saudi Arabia produces. They have an elderly president, Eduardo Santos, who's about to enter into a leadership transition. As the country has a long history of fighting civil wars. They've had 1/4 of their GDP wiped out. This is a candidate for problems. Libya, of course, we don't even need to mention, it's too obvious. Iraq as well. But Algeria, also a country that fought a civil war from 1992 roughly until 2001 or 2002. They have an elderly president, Mr. Bouteflika, who is suffering a great deal of health problems. He's very rarely seen in public, has no obvious succession plan. This is a country that also produces over 2 million barrels of oil per day. And likewise, Venezuela, a country that's nearer to the United States, but not particularly dear. A country that has seen its economy essentially implode under Bolivarian socialism. They are suffering hyperinflation. There's a lot of disputes among the opposition-controlled legislature and the president. And so there's a lot of potential for problems here. Also more than 2 million barrels per day production. So when you add up those countries, plus Libya, Iran, and some of the other problem countries, also I think Nigeria bears mentioning as well. Nigeria has already seen a flare-up in violence that caused a temporary spike in oil prices. Nigeria is a country that also has a civil war that took place during the late 1960s and early 1970s. It was very destructive. They've only recently become a democracy. They have a very interesting system in a sense that they alternate between a Christian president, most recently Goodluck Jonathan, and the current president who's Muslim and from the northern regions. But as a new president comes in, he has to slash the budget. Very, very unpopular. We've seen flare-ups and violence in the oil-producing region already. This is a country that has potential instability as well. It's a big oil producer, over 3 million barrels per day. When you add those countries together, they produce more than Saudi Arabia. So if you think about a problem occurring in Saudi Arabia, the kind of spike we could see in oil prices could be really enormous. So I think that the main upside risks are coming from potential instability among these various oil suppliers. And essentially, those instability risks become, in a sense, correlated because they're all suffering economically from the same underlying phenomenon, which is oil prices that are far, far below what they had hoped for, what they had budgeted for, and what they had based their expectations upon. So I think that that's pretty much it for the presentation. If you want, we could talk about products. I don't think there's anything happening in the product markets like ultra-low sulfur diesel or gasoline that are particularly remarkable. The spreads are at fairly average levels. But I'd be happy to turn it over to questions. I try to focus as much as I can on all of the different products that trade on the exchange, including metals, which I didn't go into a great deal of depth on. But if you have questions, I'd be thrilled to have a discussion with everyone here in this room and with people in remote offices that they can email their questions in, which I think I understand they can.
I've got quite a broad question here. One thing you didn't really touch on too much was a fairly big event that's happened recently in terms of Brexit. How do you see that playing out economically, just in broad terms?
Yes, that's a good question. I think Brexit is a difficult one to call. And so it sort of reminds me of what this American actress named Lily Tomlin wrote during the 1980s. Lily Tomlin had a play that she performed on Broadway called Search for Signs of Intelligent Life in the Universe. And her famous quote in the play was, "No matter how cynical you become, it's impossible to keep up." And so that's sort of my thoughts on Brexit. So I think that with Brexit, first of all, there's only one thing we know with certainty about it, which is that they will not invoke Article 50 this year in 2016. So I guess the question is, well, what happens next? What happens in 2017 or later? Do they invoke Article 50? Do they really begin a negotiation process to leave? I think that they kind of have to, because if they don't, the Tory party, which has a lot of rank and file members in particular, as well as some MPs who favored leaving, will probably tear itself apart if they don't leave. So I think they're under a lot of pressure to do something. But then the question is, what do they negotiate for? What sort of model do they want? There's essentially three major models. There's the Norway model. Norway is not a member of the EU. It's voted against joining twice, but it pays dues to the EU. It's accepted open boundaries, which is one of the conditions of the EU, or free movement of people, I should say. And in addition to that, it has no direct, legislative control, in the sense it has no representation in the EU. So I think that model is pretty much out. It would be too humiliating and too embarrassing to leave, but to still pay dues and to still accept people into the United Kingdom. So that one I think we can pretty much safely rule out. The second one is the Swiss model. The Swiss model is essentially similar to the Norway model, but they don't actually pay dues into the EU, but they essentially have agreements with all 27 member states. Now the problem with that is to negotiate an agreement with 27 different countries individually takes a very, very long time. And so the Swiss were able to put this into place very slowly as the EU grew over time. They're doing it one by one as new members adhere to the Union. So the Brits suddenly find themselves in a situation where they have to deal with this all at once. Lastly, there's the sort of pure outsider model, which is the case for Australia, Canada, and the United States. And we all have our own trading relationships with the EU. And so I think it's ultimately more likely that they leave completely. I think the question is, so what impact does that have on the UK? Well, the millions of people who trade in the currency market have already rendered their verdict. The pound plunged in the days after the vote from 150 to 130. But with the lower currency, that offsets some of the economic damage that could potentially be done by leaving. And so when the Brits go into this eventual negotiation, they do have their strong points in the negotiation. For example, the Brits export $46 billion worth of goods toward Germany, but they buy $100 billion every year. So it's more than a 2-to-1 ratio. The ratios aren't quite as skewed, but nevertheless in the same direction for the Netherlands, for France, for most of the other EU members. So if the EU really tries to sort of attack the UK economically as a result of them leaving, it could really be a self-inflicted wound. So I think that ultimately what's likely to happen is something that looks very, very much like the status quo. I think that maybe the most cynical possible outcome you can imagine is that Theresa May has essentially chosen Boris Johnson, the former head of the Brexit campaign, as the foreign minister, along with 2 other pro-Brexiteers, to negotiate with the EU. So it could be that they negotiate something that's really, really awful. They take it back to the voters and have them vote on it again, and then wind up staying in the EU entirely. That's one possibility. I don't know if that will happen, but if you were really cynical, that's one of the possibilities you might think about. Of course, I'm not really that cynical. But the other thing is, one of the other pro-Brexit arguments was that, well, sure, they have this great free trade relationship with the EU, but if they get out, they can negotiate free trade agreements with the US, Canada, Australia, India. Okay, that may be true, but the problem is they do 45% of their trade is with the EU. 1% was with Australia, 1.7% with India, 1% with South Africa, 1% with Nigeria. US is like 11%, Canada's 5%. The numbers don't really add up. Even if they reach free trade agreements with a lot of their other former colonies, former territorial possessions, it won't really offset the potential damage of higher tariffs from Europe. But I think ultimately there's going to be a lot of pressure on both sides to sort of work things out. The other problem with Brexit is that that's sort of the British side. On the European side of the negotiation, you have no idea who they'll be negotiating with. The Italians are going to have a referendum next month. It's likely to lose on constitutional reforms. Matteo Renzi might have to resign as prime minister. The French are having elections in April, May, and June of next year. It's very unlikely that Francois Hollande will be re-elected. Angela Merkel is collapsing in popularity, and that could be made worse with the stark drop we're seeing in Deutsche Bank stock. If in addition to having a migrant crisis, she also has to bail out Deutsche Bank, she might not be in power a year from now. The Spanish have now had 2 elections and are heading for a 3rd election because they can't decide who they want to govern themselves. So on the other side of the negotiating table, we have no idea who's going to be in power. So I think that also makes it really hard to see how it plays out.